This one is going to get a little nerdy today. We're going into a lot of data. Hopefully this is going to bring you a lot of insight. So just a real quick background on me, and thanks for the introduction, guys. So after I graduated college in 2012, I actually spent 4 years in the corporate world. And that's all I did was basically look at charts, do data stuff, tell stories from where trends are going, and I didn't talk to anybody. I was a head down number cruncher type guy, and so that's all I did for 4 years. So I ended up deciding that job wasn't good for me. Went into real estate and took that with me. And it's interesting. There's not enough agents or there's not enough investors that really care about the numbers as much as I do. And I thought that Chicago was really missing a big data opportunity where we could have just regular insights delivered to your inbox. And so basically I put together a Wagner Report, which is all Chicago market analysis, and we go deep on this stuff. So anyways, I got a background in flipping houses. I have a rental portfolio in the Northwest Side, about 14 units. So I've got a wide range of experience, and then I also built kind of a brokerage, and all of our agents are investors themselves. Actually, Jordan Warner is here, so thanks for coming, Jordan. But that's what we require. We require all of our agents to be investors in order to hang your license with us. So we're going to jump into it. We got a lot of stuff to go over, so we're going to start with the economic indicators. We're going to look kind of a top-down, what the overall market kind of looks like, and then we're going to go into how it impacts Chicago, what the Chicago market looks like. I'll give you my forecast, and I'll leave you with some top neighborhoods for appreciation and some top neighborhoods for cash flow, which in my opinion is going to be the most valuable piece that you can walk away from today. So the biggest question we have right now is how is the market? And we've kind of got 4 different people we're going to be talking to, which is buyers, sellers, investors, and agents. Anybody who wants to be a volunteer real quick and say if somebody were to ask, who wants to be my buyer? If I were to ask you, how's the market? What would you say in one sentence or whatever?
Scary.
Scary. Yeah. Anybody else? I would say it sucks, right? Rates are too high, prices are too expensive, and I can't believe how quickly homes are selling. It's typically what buyers are saying right now. What about sellers? Anybody want to be a volunteer? What's the seller going to say? How's the market?
Tough.
It's tough. Yeah. Or it's good.
Or it's good.
So I could say it sucks because there's nothing to buy, and there is no way I'm giving up my low mortgage rate, right? We've got a lot of people that have locked in low mortgage rates right now, and it's hard for them to buy something. Investors, what are investors going to say? They might say, it sucks. Nothing pencils out. There are no deals, and the cost of money is too high. But at least I'm getting nice rents, and my units are filling up pretty quickly, right? How about agents and lenders? What am I going to say today?
It's great.
Yes. It's a great time to buy and sell, yes. It's always a great time to buy and sell. Yeesh. Should I make this a little bit better? All right, so what's driving the market, guys? It's really all about interest rates, and you'll see on the left side here, I've got a 30-year fixed mortgage rates, and you can see how quickly we've gone up from a 2% range, and actually it doesn't show on the slide, but we're at 7.27 right now on the current mortgage rate. And really how that impacts home affordability on the right-hand side, and you see this chart, and anything, we've got that dotted line at 100, it basically says anything above that was really affordable, but as soon as rates started increasing really fast, we've gone into this less affordable range. And so now, if you look at this chart, we're actually at the least affordability that we've ever seen on this record, which is back to 1997, right? One thing to note is that I've got these little status markers on here. I've got a red light on that status mark. So both of these, we're going to look at some indicators. We're going to give you a red light, green light, yellow light type thing. Both of these considered red lights. Okay. But what's driving the interest rates is really all about inflation. And so I wanted to show you a historical view of what inflation looks like compared to the 30-year fixed mortgage. So inflation is your yellow line, and the 30-year fixed is the blue line. Okay? And anybody that doesn't really know anything could actually look at this chart and be like, hey, these two lines kind of look like they correlate with one another. They kind of move. When one goes up, the other one kind of goes up, and then when inflation goes up and it comes back down, it seems like inflation rate or mortgage rates would also do the same thing. They go back up and then they come back down. There's a number of instances where you see that. On the furthest right-hand side, you see that inflation has come down from its peak of last June. So I'm kind of a data guy, and so I did a correlation analysis, and I've never looked at it from this way, but I wanted to show it to you because this is an interesting part. When I took both of these data pieces, I found that this is about 59% correlated. Now, 59% is actually not that solid, but when you do notice is like, okay, when inflation goes up, the Fed reacts and then they raise rates. But what if we did the analysis based off of an 18-month lag? So here's what I did. So I just shifted this mortgage rate, right, by 18 months. And I ran that same analysis, and I ended up finding it's 72% correlated. So being closer to 75 actually means that you have a stronger relationship here. So think about this from the perspective of like, well, if we peaked last June, okay, in inflation, and that's been coming down, 18 months from then would be the end of this year. It's very possible, and this could be totally wrong, but this is just my hypothesis. It's very possible that we might start to see rates come down by the end of this year. And if you've seen some articles lately, they're actually saying that experts are thinking that it could come down by the second half of next year, right? So I did it also on a 24-month lag, and the same correlation still exists. So anyways, I wanted to point that out to you because I think it's very interesting. So this is a yellow light in my opinion. But it's not just inflation that's driving rates higher, it's really more about the, I don't know why it's doing that.
I'm sorry, I don't know.
Yeah, I'm not sure why it's doing that. Thanks.
Yeah, maybe just turn it down.
Thanks. Is that better?
Yeah.
Turn on the volume here a little bit.
Yeah, we'll turn down the volume a little bit.
Yeah.
Oh, yeah.
Oh, yeah.
That's right. Thank you.
All right, how's that? Okay, whatever, you guys can hear me. If you can't, just let me know. All right, so it's not just inflation that's driving the market higher. It's actually also, there's a relationship between the 30-year fixed rate and the 10-year treasury. And I want to show this to you because on the left-hand side, you'll see that there is a relationship there. There's definitely a relationship. And typically, the spread, the difference between those is about 2%. And so I show the spreads on the right-hand side there. And the average is that orange line, about 2%. Right now, we're actually up closer to 3%, and the whole reason is that we've got lenders that are doing a lot less transactions, and because they feel uncertain about the market. So when they're lending on deals, they want to make sure that they have a little bit more profitability on the deals that they're doing, so they've increased their spreads. But it's actually thinking that if we were to bring the market back to more of a normal market, we would think that the spread is actually going to revert back to the mean because they're going to have to be more competitive on deals. There are going to be more deals that will happen. And actually, it would say that a 7.5% rate today is truly a 6.5% rate once spreads come down. So that's another reason to think why rates could come down. But right now, they're still up pretty high, so it's still a red light there. Think about supply and demand. On the left-hand side, we've got inventory of homes for sale across the nation. This is from the National Association of Realtors, and it's just very obvious that single-family homes, we don't have enough of them. We have a very big inventory problem. And on the right-hand side, we measure demand, and the way that we do that economically is thinking about household formations. And what's a household formation? It's basically when you get two people that come together and they rent an apartment. They just graduated college and they rent an apartment. You get a couple that gets married and they buy a house. That's a household formation. And if you think about it, we're actually at it's like 1.3% growth. It's still growing in the household formation, saying that there's still strong demand for housing there, right? So we got two green lights on this one. And then there's the argument that says, well, inflation happened, people are living paycheck to paycheck. But we've also seen that wages have risen as well. The left-hand side here is showing you inflation, the gold bar, versus wages, right? And right now, we're actually seeing that wages are higher than inflation, right? So people are actually making more money than what inflation has been going up recently, right? So this is a really interesting point. That, in my view, has made this into a green light here on this one. And then the unemployment rate has been trending downward. We're at like 3.8% and 4.2% for Chicago. So pretty healthy unemployment rate as well. How does it actually, like when you think about Chicago, what makes Chicago so great? It's all about the jobs. And job growth is actually still positive. You can't see the number on this chart, but it's 1.3% for job growth that's going on in Chicago. That's why people come to the cities, because of the jobs. But even though we do see Chicago having the population decline, and it's been doing that for quite some time. So We have 2 yellow lights on this front just because I had the job growth kind of slowing down, but it's still positive, and then we obviously have a population decline that's going on. So overall, as we're looking at all these indicators, right, this is the mixed bag. We could see like, well, you could say it kind of sucks, or you could say it's kind of decent. In my opinion, I'm putting the most weight on the inventory problem, right? So if you were to think about inventory, if we have inventory starting to climb, it's really going to change the market. But right now, we're really constrained, and so of all of these, I'm holding on to inventory. I'm also going to look at inflation and where that ends up going, because that's going to do a lot of things to interest rates. So what about Chicago in total median sales prices right now? So we've actually been declining in values. I don't know if you guys have known this, but we've been declining here in the city of Chicago for the last year. We're actually down 3%. But we did go through this huge boom during COVID, and it kind of leveled out. But over the last year, it's been declining. What's going on with the buyer activity? This is all under contract activity. And what's interesting, this is one of the most important slides. What's really interesting is that during COVID, buyers really took off. There was a lot more buyers that entered into the market. And then as soon as rates rose, they ended up declining and getting out of it. They retreated because of the unaffordability. But what's happening over the last 3 months, and I think is very important, this is why I put this line here, I think we have a potential bottoming that is happening. And buyers are getting much more comfortable with where rates are, and I think that's boosting their confidence. And you're seeing this slower rate of decline over the last 3 months. So this is a really important thing to kind of note of, because if people are like, well, I don't know what the future looks like. Well, I don't know, to me, this looks like we could potentially have some more confidence coming back into the market. And so what does that do when you have limited supply? Well, it might change things on your price. How about the sellers right now? So new listings, this is what this looks like. Sellers are not motivated whatsoever. Remember, we locked in all of our low rates, or we don't have a mortgage. And we don't have any sellers adding to the inventory, right? So if we have a little bit more confidence coming from the buyers, but we don't have sellers adding to the inventory, right? So what does that kind of look like in your eyes? And so that looks at, we talk about inventory in a way of like months of supply. If you're not familiar with months of supply, it's basically how many homes do we currently have for sale, given the pace of buyers and how fast they're buying them. So basically saying in 3.7 months, we would sell all of our inventory if we didn't have new listings come to the marketplace. And when you look at it where this was pre-COVID, we were at 5 months. So the lower the number, the more of a seller's market that we're in. And even though we've had all of these buyers retreat from the marketplace, we still don't have months of supply like gaining at a fast clip at all. We've come up a little bit, but not much. So that little increase at kind of the bottom there, we're at 3.5 up to 3.7, that actually helps explain our pull down in price over the last year. But it's been very modest. So total homes for sale, this is what this looks like. Just a straight decline, down 32% from where we were like in 2019. So we just don't have any inventory coming to the market. It's important to understand Chicago's seasonality and kind of, especially as investors, when should we be buying our properties? Right? When we have the most competition out there or the least competition out there, right? So this chart on the left is going to show you exactly what the seasonality looks like, and specifically the dotted line. So the first 4 months of the year, that's the spring market. That's when we have the most buyers every single year. This is a 10-year average pre-COVID. Okay? And then it just kind of tails off like a little roller coaster, right? And then by the end of October, November, December, this is when deal season is, right? People that are going to be selling their houses during the winter time, it doesn't really make much sense because there's not a ton of buyers, right? They have to sell for a reason. And so it's important to understand the seasonality metrics of when you should be buying deals. We're approaching that. But also at the same time, what does this tell you about buyer demand? If you look in August, those are like neck and neck between where we are on a 2023 metric and where we are on the average. That was literally the exact same, this last August was what we expected for buyers. It was the most normal August that we've seen. So again, it kind of speaks towards buyer demand being pretty healthy. And on the new listing sides, just not existent. We don't have enough sellers, there's no motivation. In my report that I do, the Wagner Report, I break down things for all neighborhoods by condos, single family homes, and 2 to 4 units. And here you can see some price movements on where across the city what was doing well. So 2 to 4 units in single family homes actually during COVID saw the biggest booms, and then they've all leveled out, and we've seen price declines for all 3 of these property types. If you look on the right-hand side, I kind of want to point this out a little bit because it's a good example. The orange line, which is single-family homes, we had this dip down in price. We were up at 315 down to 300. And if you look at how that correlates to your months of supply, right? So when months of supply goes up, you're likely going to get a pull down in price. And we did see that because we hit the bottoms for months of supply during COVID, where single-family homes were like the most sought-after properties. And then rates rose. Inventory started to build just a little bit, and buyer demand pulled back. But we also saw prices decline. Right? So one thing to kind of point out, the very right far side of this slide is that you see all 3 of these property types ticking back downward this last month. And so we're going to monitor that, and we're going to see, like, if they're ticking back downward, it means that there's a greater demand coming back into the market. So we'll see how that ends up shaping up over the next couple months. All right, turning over to multifamily and like where we're at on the rental side. So this is asking rents is the orange line. And you can see that rents have gone up dramatically. We had rent increases, which is the growth rates, the gray bars, during COVID was about 8%. And typically Chicago's always been around 2%. Okay, right now we stand at 3.6. So it's a good time to be a landlord, good time to be increasing your rents right now because you can. And how does that correlate with vacancy rates? Vacancy rates are our gray bars here. We're at the lowest that we've been, 5.3%, where historically Chicago's been between 6 and 7%. So things are filling up quickly. There's not enough housing on the rental side. And so that's why you can raise your rents right now. How about if you're buying a larger multifamily building? So we've got, when interest rates rise, cap rates have to rise. Okay, and we've seen the multifamily price per unit actually fall as well. So larger multifamily buildings have had prices come down. It's just how the numbers have to work out. If you want to be buying larger stuff, well, you've got financing costs, and that financing cost is really impacting your deals and what you can buy them at. All right, so here's my forecast. So we're going to start with price. I think in the near term we're probably going to continue to decline, but with 2024, I think overall 2024 we're going to see price increases. I think we're probably through, not potentially through the worst of it, but you're going to see prices increase in 2024, mainly because inventory is going to remain limited. Okay, we don't have sellers that are motivated to sell right now. Interest rates really need to come down in order for sellers to feel motivated to sell. There was a stat that I saw, it was like 92% of homeowners have a 6% rate or less. We're at 7.5, roughly, right? So really need some type of motivation to come back for the sellers. Buyers, I think that we're gonna continue to gain some confidence. People still have life events happening. People recognize that like rates are what they are, and we should, and we're starting to see that bottoming happen. And then interest rates, I think that they're gonna rise. I wouldn't be surprised if they touch 8%, but I think by the second half of next year, if you remember the correlation analysis, kind of like makes a little sense that they might decline at that point from their highs. I don't know exactly where they're going to be, but I think that they'll decline from their highs. And then I think that for rent growth, this is the bottom one, I think we'll have modest growth between 2 and 3%. We've got some market risks. I want to lay these out for you. I mean, the Fed could totally raise interest rates way too hard, way too high, and they could break everything. 2024 is an election year. I think this is actually going to favor the real estate market a little bit more. If you think about the incumbent and like where he would want the economy to potentially be by the time election season, maybe you have interest rates kind of falling down to that point, in which it kind of makes a little sense what we've been talking about. Maybe second half of next year where we have rates falling, that would help an election year, for sure. What about Chicago's political agenda? I mean, we've got a crime problem. We're up 29% year to date on crime, 54% from 2019. So something needs to happen there, because otherwise, I mean, it does contribute towards our declining population, but these crime numbers don't help. And then we also have a mansion tax that is being proposed by Mayor Johnson. I don't know if you guys are familiar with this, but basically this is the new transfer tax for any buyers that are going to be buying a property that's $1 million or more. He wants to 2x to 3x the transfer tax. So that could really do a lot of the reasons that they want to do is because they want to raise money for homelessness and help that. It's just, this is a pretty interesting way of how they're proposing to do it through the transfer tax. So we don't know exactly what the unintended consequences will be on that, but I think it's a risk. And then wages and job growth or job declines, that might happen, right? We might enter into a recession and we might have wages pull back and jobs fall off. But here's the top 5 median sale prices for appreciation rates across the city on the north side here. So on the right hand side, we got 2 to 4 units in single family homes and condos. These are all ranked based off of the best appreciation rates that I've been seeing. And if you're on my report, I send out a top 10 list. I also give you like the bottom 5 lists. So sign up for the report because there's a lot more information in there that you can kind of look and analyze. But then additionally, this little sheet of paper that I've got a stack of, if you don't have one, it literally has all 77 neighborhoods and it has all of their price movements and data behind that. It's some of the most valuable things that you can have, so make sure you grab one of these pieces. And so anyways, 2 to 4 units on the right hand side, Dunning, West Garfield Park, Rogers Park, Norwood Park, Lincoln Park. These are all between 9 and 14% gainers on that. If we move to the south side, this is interesting. 2 to 4 units for Washington Park, West Englewood, East Side, West Pullman, South Chicago, between 13 and 63%. I actually had to check that number on the 63% for Washington Park because I'm like, what is going on there? So this morning I found like 7 or 8 comps that are supporting like 650, 700 or higher. I even saw some $1 million properties that were going on in Washington Park. Now I haven't been to Washington Park lately, but this is interesting to kind of see, right? Because when you see a number like this, you're like, what the heck is going on? And you just kind of dive deeper into it, and maybe that helps you identify an opportunity that could be in that neighborhood.
That's where the Obama Library is.
Yeah, it's close, right? And then this is my favorite part. All right, so this is where we can find our cash flowing properties, and it's all based off of this 1% rule. Okay, and this is the rent to price ratio on the right hand side. So if you're not familiar with the 1% rule, basically this is, if you were to look at a building, what is the monthly rents, add it all up and divide it by the purchase price. And if that equation comes to be as close to 1% or higher, like you should look at that deal. And so I took that same thought process and I did it based off of median sale prices for the neighborhoods for 2 to 4 units. And then I actually have average rents on here. And I came together what would be, assuming 3 units, our rent to price ratio. Okay? So this is all based off of North Lawndale, East Garfield Park, West Garfield Park. Like these are the areas where you can find the best cash flowing properties and neighborhoods. Okay. Now they come with a certain risk level. It's not where every investor wants to be. I play in the Jefferson Park area, Avondale a little bit, Hermosa, Portage Park. I like those areas, and I want to point something out here because I thought this was interesting, especially Jefferson Park. We've actually seen a 9% decline in 2 to 4 units in Jefferson Park. But if you look at where the rents, this 4.4% that I have there, rents have increased. So what does that do to your rent to price ratios? All of a sudden it increases them, right? It gives you better opportunities. So same thing with Avondale. Avondale's one of them. 6.4% we've seen a decline in 2 to 4 units, but we've seen a 7.3% rent raise. So you start to think about Avondale a little differently. That's when I saw this, I'm like, I'm looking for a deal in Avondale. And then here's the south side, what that looks like. West Pullman, New City, Roseland, Englewood, Greater Grand. I listened to the Straight Up Chicago Investor podcast, and there was a guy on there that talked about back of the yards. And he's like, dude, the cash flow. Yeah, do you remember who that was? Was it you?
Yeah.
Dude, Ben, yes, I'm so glad. God. You're like, yeah, so the cash flow is like ridiculous. Okay, well, it makes sense. New City is on my list, right? So anyways, there you go. If you want to learn about back of the yards, what episode was that? 202. Listen to Straight Up 202.
Straight
So
Up
funny.
202.
I'm so glad that was you. All right, so that's the end of it, guys. Sign up for my report if you're not already on there. I send it out on a monthly basis. There's a ton of good information for you. Here's my Instagram. I am very active on Instagram. I post a bunch of stuff. It's mostly real estate or like 75 hard stuff. So give me a follow. But any questions that you guys have about the data or where things are trending, forecast?
Any questions, guys? Questions, concerns, comments?
Was this helpful at all?
Yeah.
Like,
Oh yeah.
Yeah. Is it too much? Yeah.
No.
They're building the expansion of the red line. Is it the 70? Are they making the 70 neighborhood, or is it just called the 70?
Oh, right. Yeah, it is.
Like
They are
Harvard
making.
Roosevelt?
Yeah, that's what they
70?
call it. Yeah. Related is the
Yeah.
developer on that one. Yeah. So they are making it the 78.
Oh, really?
Yeah. Yeah.
Dang, that's sick.
Wow. Yeah.
That's
Yeah.
crazy.
Yeah.
So they figured, yeah.
I think they're just calling it the 78.
Right, yeah.
Yeah.
Is the new mayor gonna change anything, or you think anything in the city is gonna change regarding eviction processes?
Oh, eviction processes. Let's see. So they are thinking about the just cause. Have you heard about that?
Yeah.
Just cause eviction process. So it's basically you have to have a reason to kick out your tenant. So you can't just not renew their lease because you want to rehab the unit, or because it's not a good fit, things aren't working out. I had that for one of my tenants where he was. I had a guy that was down the garden unit, and he would bang on the ceiling, with the people above them because they had kids that would run all the time. And so I got to a point where I said, "Look, this isn't working." And he's like, I told him, I said, "I'm not going to renew your lease." If you think about it from that perspective, I was so glad I did that because that changed the building dynamic completely. We were actually kind of afraid of this guy that was down there. And if you think about that new ordinance that could potentially come in, well, now I couldn't get rid of this guy because he pays on time, he keeps his unit clean. You'd have to find some provision in the lease in order to...
They have to be in breach of the lease.
Right, they have to be in breach of the lease, yes. So that's a potential thing that could be coming, what I heard. But the most recent is the mansion tax, it's the transfer tax. And what that also is going to do for downtown, which is very interesting. It's coming at a time where downtown vacancies are at 25%. I heard somebody say that one of the meetings I went to for the MBOA, it's about 16 Willis Towers worth of vacancy that we have downtown.
Oh my God.
If you think about it after, it's holy cow. And so what's going to happen there is that you've had a lot less transactions. And that transfer tax is really going to disincentivize a lot of buildings downtown to be traded, which is already happening. But at the same time, you've seen values almost half of what those properties that are worth downtown are halved. So what does that do to your property tax burden? Where the city was expecting to get all of this property tax from these values that were here before, it could be reallocated to the residential side, right? So I think that's the timing of this mansion tax coming in is really bad because of the all-time vacancies that we have downtown. Yeah.
Would you recommend as a new landlord to join any real estate associations like MBOA or I'm super unfamiliar.
Oh, for sure. Yeah. The MBOA is great because there's a bunch of small-time landlords that are there. They also have people that own thousands of units. That's a great organization to go to. And then actually through the Chicago Association of Realtors, you can sign up for property management classes that are there. And I've done them. They've been a 3-day thing. And you can learn everything that you need to know about how to manage your own property and all the lakes laws and whatnot. Those are really good classes to take for sure.
That's a realtor.
Yeah, I am. Yep.
Or
Yep.
what if you're not a realtor?
Yeah. Even without being a realtor, you can sign up for those classes and you can do them. Yep. So through the Chicago Association of Realtors, you can sign up for those classes. Yeah, so check out their education tab, and you can do that without being a member. October 13th, there's a free. Did you sign up for that one? Oh, okay. Yeah, so on October 13th, there's a property management class that's happening that you might be able to sign up for. There's other organizations throughout the city that do free ones. I want to say the CIC, which is a commercial lender, they offer property management classes. I know Mark Ainley talks pretty highly of that one. I haven't sat in it, but yeah, there's also look for that as a resource as well. Anything else, guys? Cool. Thank you so much. I appreciate it. Thanks so much for your time.